Good morning. Today is Tuesday, March 28th, 2017. I'm joined here at the New York Stock Exchange with Keith Bliss of Cuttone and Company, and he'll weigh in on everything that we have to focus on this morning. Keith, good morning.
Good morning, Remy. Good to be with you again.
Well, we have a slew of Fed speeches this morning, so focus might shift on over to monetary policy versus fiscal policy. But this is the first time that we have spoken since the failed attempt at repealing Obamacare by the Republicans. So in terms of overall strategy, what's changed for you?
Well, it's still crazy, so that's not changed at all. But I think you need to take each passing day with what's coming at you. And as you correctly pointed out, monetary policy is going to be the subject today. And it's actually a welcome relief given the shenanigans that just seem to continue down in the Beltway and will never end at this point in time. And the markets are reacting as the news and information comes at them. I rely on my tools and other devices that I've developed over the years to be able to do that. Not everybody has access to them. But I think the market moves, given the slack volume that we've seen for the last 2 months, will be dictated primarily by what's happening on that day, whether it's a failed attempt to repeal Obamacare or whether it's a lot of Fed speak, which we're going to get today.
And when you look at some of the financial news headlines, you're starting to see words such as valuation or correction or bear market territory. But given the overall picture, when you look at the equity averages on a technical basis, we did begin to see some cracks last week when we look at some of the indexes and the technical levels. So what levels are you watching right now?
Well, right now on the S&P 500, we're most concerned about it trading down around 2,100, maybe a little bit above. That, to us, would be a significantly oversold level. It already is oversold, and all the major averages in our work have been oversold since last week. But that level is really looking where it needs to draw a line in the sand and hold on to it. And we saw a little bit of that yesterday. We got within 12 or 13 points of that level, that range, and then the market turned around and came back. On the Dow, it's not so much in jeopardy right now. That is the one index that has performed the best over the longer term. And the Russell 2000 is the one that's really broken down substantially across some major trend line support that we've seen going all the way back to 2011, 2009, and even what we've seen since last fall. The Russell is the one index that concerns me because it has the tendency to lead everybody down, but then it lags on the way up. And right now it's been leading everybody down. It did have a little bit of a respite yesterday, which is good to see. So to the broader point, though, from a technical standpoint, also what we see on a macro level, I clearly don't think that we're about to enter into a bear market. I don't think that this rally, we can say that this rally is over at this point in time. I actually think pullbacks like this can be constructive and healthy for a market. It's difficult and people get nervous and antsy when things move up in a straight line or they move down in a straight line. So the ability for the market to sell off a little bit, to clear out the weak hands, bring some new money back in, either from overseas or domestically, is important. And I think that's what we're seeing over the next couple of weeks.
And last but not least, Keith, I do want to shift our focus on back to Washington, D.C. Now, given that there are hopes still for stimulus measures in the form of tax reforms, economic stimulus, how do you see that playing out in terms of timeline?
A little bit longer than what we had at first thought. I think the repeal, the failed repeal of Obamacare is not going to be all that damaging to our economy unless, of course, you subscribe to the viewpoint that Obamacare is imploding and will continue to do so, and that could have a real harmful impact on both individuals as well as the overall economy. The problem with that failed attempt, though, is it's now backed up the president's agenda, and it's also put it in a different light where people are now not as trusting about moving these things forward. It's going to be, we'll make a move when we actually see the legislation go into effect. So I think people need to manage their expectations a little bit. The problem with the equity market as it relates to that is we'll probably move sideways a little bit within 100-point ranges on the Dow, maybe 50-point ranges on the S&P, and we may not go anywhere for some time to come.
Okay, Keith, well, as always, thank you so much for your insight and thanks for your analysis.